Happy Friday, everyone. Hello and welcome to Business Daily. I'm Ji-yoon. Let's get started with a look at today's highlights. With the bird flu outbreak and ongoing drought pushing up food prices, the government and the ruling party discussed various countermeasures. It was a busy week for central banks around the world, and we take a look at what kind of decisions were made at their meetings. These stories and more coming right up. There are open and cooperative exchanges between the ruling party and the government this morning at the National Assembly. It was their second time meeting under the new Moon Jae-in administration, and both sides agreed to work together on issues like the avian influenza outbreak and the ongoing drought. Our Shin Se-min starts us off.
The government and the ruling party are working together to tackle the latest bird flu outbreak and a prolonged drought that has caused food prices to spike. At a meeting on Friday, the ruling Democratic Party of Korea asked the government to continue its efforts to enact countermeasures on issues that affect people's livelihoods. As for the latest bird flu outbreak, the first case confirmed since November, both the ruling party and the government agreed on the need for a better system to curb the frequency of such flu outbreaks. The country's agriculture ministry has raised the bird flu alert level to its highest and had even established travel bans on live poultry and also culled nearly 120,000 birds. As for the ongoing drought, one of the worst on record, the government and the ruling bloc discussed possibly allocating some of the extra budget to cover the damage. The ruling party promised to secure extra money from the government's $9.9 billion supplementary budget bill after it's reviewed in Parliament. Data shows the country had seen precipitation this year at just 47% of its normal level, the second lowest amount since related data was first collected in 1973. And in the face of rising food prices, mostly triggered by a shortage of supply, the government pledged to do what it can do to reduce the financial burden on individual households. Starting with items like chicken, eggs, and produce, the government said it'll gradually work to stabilize overall consumer prices. Shin Se-min, Business Daily.
It seems the local currency will continue its rally against the greenback along with other Asian currencies. According to a Seoul-based finance institution, the won has strengthened 6.9% against the greenback since the end of last year. Now, that's the biggest gain among major currencies. Over the same period, the Taiwanese dollar and the Japanese yen also rose substantially against the U.S. dollar, both strengthening more than 6%. Experts believe the greenback will remain relatively weak for the time being, as the most recent Fed rate hike was widely anticipated and will not significantly change market trends. The Korean equity market continued to show a sluggish picture in the last session of the week. The U.S. market that fell overnight affected the overall sentiment. To give us a wrap-up of this week's stock market action, we're now joined by our markets contributor, Choi Jin-seok. Hello, Jin-seok.
Thanks for having me.
All right, so how are things looking on the last day of trading?
Both the Kospi and the Kosdaq market showed a somewhat sluggish picture, although they were both up at the close. The Kospi closed mostly flat at 2361.83, while the Kosdaq followed with a 0.1% uptick to close at 670. The Kospi market opened the session with a slight uptick, raising expectations for a snap in its two-day losing streak. However, the market soon erased early gains, falling to as low as 23.56 as foreign investors started unloading shares. The U.S. equity market overnight closed with a sluggish picture as well, spooking overall sentiment of the Korean market. The technology sector once plummeted by around 1% in the U.S., leading the correction. By sector on the Kospi, pharmaceuticals, securities, and insurance were sluggish during the session, while machinery, non-metal materials, and chemicals performed relatively strongly.
Then how is the overall weekly performance of the Korean market?
Both the Kospi and the Kosdaq were sluggish on a weekly basis as well. The Kospi dropped by almost 1%, while the Kosdaq followed with a more than 0.5% decline. On a weekly basis, both foreigners and institutional investors unloaded shares on the Kospi, while retail investors were the only net buyers. Shockwaves from the U.S. technology sector and the Fed interest rate hike made investors reluctant to buy stocks. But since the rate hike was widely expected by market participants, further declines were limited. By sector, shipbuilding, semiconductors, and display showed strong performance, while software, chemicals, and distribution were sluggish. In terms of selling by foreign investors, it was concentrated in sectors that performed weakly as well.
Now, Asian stock market performance overall showed weak performance throughout the week. So, how did the Chinese market move?
Right. The Shanghai Composite Index plummeted by around 1% on a weekly basis. Investors saw a picture similar to the Korean market in the Chinese market. The tech-led correction in the U.S. and uncertainty surrounding the Fed's future policy path served as negative catalysts. The country's technology sector showed weak performance as well. Moreover, investors in the Chinese market started worrying that the People's Bank of China, or the PBOC, might push its way for tightening after the Fed raised interest rates. Experts expect the PBOC might raise rates of its medium-term lending facility, or MLF, or reverse repo rates going forward.
Now, Morgan Stanley Capital International will be making a decision next week on whether to include China's A shares on its emerging market index. So what impact do experts think this decision will have on the Korean stock market?
MSCI will make a decision at 8:30 p.m. on next Tuesday local time. And first of all, compared to last year, there are greater expectations that MSCI will include China's A shares in its emerging market index. Chinese authorities have been trying hard to resolve problems, including limited liquidity and capital flows, raising expectations for the inclusion. Domestic investors are interested in how the potential inclusion will affect the Korean market. If approved, A shares would account for 0.5% of the emerging market index as of next June when it will be implemented. Theoretically, the portion of Korean stocks in the index will decrease by 0.13%, or about 2.4 trillion Korean won. KTB Investment and Securities says capital outflows from the Korean market are expected to be between $390 million and $1.95 billion. The company says the amounts are not large enough to fundamentally drag down the Korean market. Other experts also do not think the decision will lead to a massive correction because there will be enough time before next June for investors to digest the issue.
Then how did the Japanese stock market do this week?
Although the Nikkei 225 index rebounded during today's session, the Japanese market has been somewhat sluggish throughout the week. The market had suffered losses of about 1% excluding today's session as well. Due to the correction in the U.S. technology sector, Japan's tech stocks have performed weakly. Uncertainty surrounding the Fed's monetary policy also spooked sentiment. However, today's session could be a game changer for the Japanese market in the near term. In particular, after the Fed raised interest rates, the yen value fell by the largest amount since January during today's session, helping the market go higher.
All right, thank you so much for the wrap-up today.
Thank you.
The Chinese government has released a blacklist of foreign food and cosmetics companies whose goods and services will be banned from China. And the list includes dozens of Korean companies. Our Kim Ji-yeon reports.
It appears China may be continuing its economic retaliation against Korea for deploying the U.S.-made THAAD missile defense system. Among a total of 655 companies on China's import blacklist released this month were 24 Korean firms. According to the Beijing office of the Korea International Trade Association on Friday, their products are banned for having a record of being previously denied entry by China's customs office and for a high number of reported cases of faulty or unsafe products. This time, the targeting of Korean companies may be more subtle, but on top of China's string of retaliatory measures in recent months, it still stings. In April, the Chinese authorities banned imports of more than 460 items, most of them Korean food and cosmetics goods. And that followed an import ban on more than 80 Korean products in March. Although Korean retail giant Lotte is expected to have been dealt the heaviest blow by the measures, a Korean embassy official in China denied that the latest blacklist has anything to do with the deployment of THAAD. Instead, it pointed the finger at small Korean companies' tendency to ship their products without sufficient preparation, including inappropriate paperwork and problems with packaging and the labeling of ingredients. Kim Ji-yeon, Business Daily.
The Asian Infrastructure Investment Bank is holding its second annual meeting starting today on Korea's southern island of Jeju-do. The AIIB was founded last year by China and now its 77 member countries to integrate the Asian region through infrastructure development. Now, this year's theme is sustainable infrastructure, and participants will be sharing diverse perspectives on where the bank should go strategically. This marks the first time the meeting has been held outside of China. Korea is a founding member of the AIIB and the fifth largest shareholder. President Moon Jae-in gave his welcome speech during the opening ceremony this afternoon, where he vowed to share Korea's experience and development to help less developed countries in the region. Jin Le-chun, the president of the AIIB, said the bank will support economic and social development by investing in infrastructure and other productive sectors to build a sustainable tomorrow. Asian countries are outpacing the rest of the world in terms of economic growth, accounting for 40% of global GDP. And to find out how to keep business booming in the region, our Oh Soo-young sat down with the chief economist of the Asian Development Bank.
Asian economies face a range of uncertainties that could affect their global trade. The rise of US interest rates, an economic slowdown in China, and the spread of protectionism. But according to the Asian Development Bank's chief economist Yasuyuki Sawada, through deeper regional integration, crisis can be turned into opportunity.
In terms of Trans-Pacific Partnership withdrawal by a Trump administration and the possible policy change in US and Eurozone, it can be positive and negative impact on Asian economy because this new policy change may accelerate other trade arrangements such as RCEP, Regional Comprehensive Economic Partnership, ASEAN, and other Asian countries. It's important, regardless of developed country policy change, continue for more open trade and investment.
Over the past few decades, Asian countries have embraced business on a global scale. They make up 40% of global production and lead the world as the fastest growing region in terms of annual GDP. Transactions within the region have been a key driver of that boom, accounting for almost 60% of trade and half the flow of investment. But Sawada says there's more room for growth. Asia's financial markets are still regarded as risky and underdeveloped, and with a high ratio of dollar-denominated bonds, they are highly vulnerable to risks of capital outflow as well as currency mismatch. At the same time, Asian countries are in need of long-term investment, some $26 trillion by the year 2030 for infrastructural projects.
There are, of course, developing markets which are very hungry for more growth, more investment, more infrastructure. So would you say that regional integration is the answer?
So the question is how to attract global liquidity or money and make them invest in this long-term investment. I think one way is to develop a local currency financial market infrastructure in Asia so that people can invest within the region as well as overseas and in credible manner.
In terms of promoting growth and integration across the region, Sawada says Korea has been leading by example.
So Korea is really one of the successful cases where a country transcends middle income, so-called middle income trap and middle income challenges. Korea already concluded 26 free trade areas and close to 100 bilateral investment treaties. So Korea is really playing a very important role to maintain and gather momentum of Asian growth.
Looking ahead, Sawada says the ADB will support sustainable development in the region by expanding its capacity to offer various financial instruments while sharing its knowledge and policy recommendations. Oh Soo-young, Business Daily.
Now, it's not a stretch to say that the relationship between Korea's traditional markets and the country's mega retailers has been a pretty one-sided war. For years, Korea's big commercial outlets have threatened the very existence of traditional markets. But recently, there have been signs that the two can indeed grow together. Our Kim Jong-soo has the story.
Korea's traditional markets are usually located far away from the big commercial retailers, so that the smaller shops have some room to breathe. Common sense, it might seem, but there's a unique experiment going on in Tangjin that goes against such notion. This two-story building was raised by Tangjin's municipal government in 2015 as an attempt to modernize the city's fish market, which has a history of over 30 years. The original plan was to fill both stories with local shop owners, but no one was willing to take the risk of moving in upstairs, which is less accessible for customers. That's when the shop owners themselves suggested contacting one of Korea's biggest retailers.
We reached out to E-Mart because we believe that would help attract more customers, and young customers specifically. Our strategy has had a definite impact so far.
As a result, the building is now a fusion of opposites. The first floor features a traditional seafood marketplace, while the second floor features E-Mart's no-brand store, a discount store that, as its name implies, sells goods at low prices by skipping the entire branding and packaging process. According to the store manager, there's no overlap or competition between the goods available on the first and second floors.
We opened in August 30th, 2016. Our processed foods, such as chips, are always very popular. Our household products like detergents are always in demand.
Customers in general have also welcomed the union.
I came here to buy fabric softeners for my baby. I usually just come to the traditional markets on market days, but now I come here more often.
E-Mart's corporate social responsibility team explained they had opened a store because they sensed an important shift in the market.
As of now, big retailers and Korea's individual shop owners are basically in the same boat. Customers these days choose between shopping online and offline. And we really think that the combination in Tangjin can offer a meaningful and very special offline experience for customers.
Experts studying Korea's small business economy have also viewed the news of Tangjin Fish Market's makeover in a positive light.
Since 2012, the government has tried to enforce limits on the working hours of big retailers, but the picture is not so simple. Our surveys indicate that consumers want traditional markets to catch up with modern consumption trends, such as payment methods and improvements in hygiene.
Tangjin's individual shop owners also know that they need to be more aware of customer satisfaction.
I keep telling my fellow shop owners we need a different, more collaborative mindset inside this building compared to when we were out on the street. If a customer has a bad experience with one of the shops in this building, there's a good chance he will never visit this facility again.
It's been less than a year since Tangjin Fish Market welcomed E-Mart. Whether the fish market can re-establish itself as the symbolic heart of Tangjin's economy remains a question waiting to be answered. Kim Jong-soo, Business Daily.
Time now for a look through some important global business stories from the week with our Eunice Kim, who joins us in the studio today. Hello, Eunice.
Happy Friday.
All right, so we're wrapping up a central bank week. The Bank of Japan, the Bank of England, and the U.S. Federal Reserve all had their policy decisions this week.
That's right. And of course, all three are at very different places in their monetary policy in their economies, especially when it comes to dealing with inflation. Let's go ahead and begin with the front runner of the pack, the U.S. Federal Reserve.
As telegraphed, the Federal Open Market Committee raised its benchmark interest rate by 25 basis points for the second time this year, putting it between 1 and 1.25% and leaving its guidance for one more increase in 2017 unchanged. The news was in the hawkish tone of the Fed as it signaled readiness to begin trimming its assets, which had helped pull the world's largest economy out of the depths of a recession over 3 rounds of bond buying since November of 2008. On Wednesday, local time, Fed Chair Janet Yellen said the U.S. Central Bank could begin shrinking its $4.5 trillion balance sheet in earnest before the year is out.
We currently expect to begin implementing a balance sheet normalization program this year. Consistent with the principles and plans we released in 2014, this program would gradually decrease our reinvestments and initiate a gradual and largely predictable decline in our securities holdings.
The details of the program that analysts project could be adopted in September or October calls for letting assets mature every month without reinvestments. First, in small quantities of $6 billion in treasuries and $4 billion in mortgage bonds, before speeding up to a maximum of $30 billion for treasuries and $20 billion for mortgage-backed securities monthly, given the right conditions.
Our decision to make another gradual reduction in the amount of policy accommodation reflects the progress the economy has made and is expected to make toward maximum employment and price stability objectives assigned to us by law.
The publicized plans come as the U.S. economy has been improving overall, though at differing pace on 2 key indicators. Better than expected employment lowered America's unemployment rate to a 16-year low of 4.3% last month, but inflation looks to be slowing. Fed officials revised their inflation outlook outside of food and energy to 1.7% this year, down 0.2 percentage point from their March meeting. While equity markets have generally been on a tear, stocks rising to new highs and bond yields falling, a recent pushback in tech stocks could indicate wariness on the wind down of easy money. Now it's up to how the U.S. economy does on inflation. That will determine whether rates will continue to rise, possibly by 3 more quarter points next year and the next, or whether headwinds will force the Fed to pull back on its tapering plans.
And from the Bank of England, there was another surprise with a split in their vote this month following last week's general election results.
Yeah, you're absolutely right. Interestingly, there was no mention of that snap election in the June meeting minutes, which of course, in the end, did take away the Conservative Party's parliamentary majority, thereby injecting a fair amount of uncertainty and difficulty as Westminster prepares to head into Brexit talks with Brussels. Inflation was the key concern for Monetary Policy Committee officials, 3 of whom voiced the need to raise interest rates immediately, standing apart from their remaining 5 colleagues who voted to keep the benchmark rate at 0.25%. Thursday's minutes showed, however, that patience for UK's surging inflation was wearing thin for all 8 officials. In May, the country's annual inflation had risen to 2.9%, its highest level in nearly 4 years, overshooting both the BOE's forecast and goal of 2%.
Inflation probably hasn't reached its peak. It could go above 3% over the next few months, and that does bring problems because earnings growth is only around about 2%, so that suggests that there's going to be a squeeze on real earnings. Effectively, people will see their real spending power falling by 1%.
Meanwhile, reports say Brexit talks will begin on time on Monday in Brussels between UK's Brexit Secretary David Davis and Michel Barnier, the EU's chief Brexit negotiator. Attention will be on a timetable as well as the fate of London's prized euro clearing market, estimated to be worth some 850 billion euros daily. And finally, the Bank of Japan moved to keep its aggressive monetary stimulus program unchanged. Wrapping up its two-day June meeting on this Friday, Japan's central bank voted 7-2 to keep 10-year government bond yields near zero and keep charging 0.1% in interest on excess bank reserves. It also reaffirmed its annual government bond purchase of 80 trillion yen, or some $720 billion US, although its actual rate of purchase had slowed in recent months. This comes as the Japanese economy has been logging its longest expansion since 2006, growing for 5 straight quarters. Amid a tightening labor market as well, wage growth still remains lackluster, as is the case for consumption and prices. As for the 2017 to 2018 fiscal year, the BOJ raised its outlook by 0.1 percentage point to 1.6%.
All right, so it seems like there's no surprise there, but thank you so much for coming in today.
You bet.
And that wraps it up for today and this week. Thanks so much for watching. We'll be back next week with more at the same time, same place for your Business Daily. Until then, goodbye.